Okay, so the first perspective that, or technique that I was talking about is when we have a liability that it's attached to a long-term asset. And let me give you an example and maybe you will understand this better. Imagine that you are building a factory. So the factory is the long-term asset. And because you are building this factory, you are forced to clean a lake that is close to the factory in 20 years or something like that when you finish with the factory. Or imagine that this doesn't happen in Mexico because of the Pemex monopoly, but imagine that you can invest on an oil plant, an oil platform, and after 20 years you have to pay to leave everything clean and all that, right? So the asset is the platform or the factory or whatever, that is the asset. But you have an obligation. So that obligation to clean when you are done is going to be this liability, right? Like the environmental liability. So it's always attached to that asset. So here in the presentation, it says that the environmental liability is always attached to the asset. And this is also important, like the IFRS talk about when do you have to report for this liability, and they say that when these two things happen. The first thing is that it is a legal obligation related to the environment and related to the asset. So this is the first thing. If there is not a legal obligation, if you want to do it, you are not allowed to report it. And I think that's pretty sad. And the second thing is that there is a plausible way to determine the economic effect of that thing, right? Like, so you can calculate how much you will pay in the future. So this is the other way. I think this is easier because imagine that you want to clean, but the accounting standards doesn't allow you to account for that liability, which I think is very sad. So some examples, I think I already said this one about the oil platform or gas platform. I also said about a company near a river or a lake, but also cleaning nuclear facilities, which is also not allowed in Mexico for private companies. So those are examples of that. And the second thing, when environmental expenses, and this perspective talks about expenses that are related to a source of income. So let me give you again another example. Imagine that you are a construction material company. So maybe this kind of companies burn a lot of fuel because they need heat to create the materials. So they pollute a lot. So when they pollute, they usually have to pay a fee, which is called a carbon emission fee. So these kind of companies, they make a profit from creating the materials and burning fuel, but they also have to pay this fee, the carbon emission fee. So this is a good example of that. These environmental expenses need to be reported somehow. Other examples are like wood exploitation, like maybe when you cut trees and then you sell the wood. It is very possible that you also have to pay a fee for cutting the trees. So that fee is an environmental expense. And carbon exploitation is similar to wood exploitation. So you have to pay a fee for taking advantage of something that will give you some income. And there are two ways to account for this. One is called the net liability. No, it's not net liability, it's net profit approach. Sorry, there's a mistake here. So in this method, you consider only the expense. So you only consider the expense that you are paying. So we will put it into practice, but that's the basic idea that when you report, you only report the expense. And in here, the other approach is called government grant approach. It considers both the expense and the revenue. So in your financial statements, you have to include also the revenue, the income, for example, the income from wood exploitation plus the expense, or the income from carbon emissions plus the expense. I think it will get clearer when we practice it. It's actually pretty easy. We're going to start with this one because I think it's more complicated, and this one it's pretty easy. So let's do now the video example.